All right, ladies and gentlemen, welcome in. We are honored to have our esteemed guest, Notional Ed, with us today to share on the wonderful, wonderful world of T-bills. And we've kind of called this, starting a side hustle with these things. And side hustle, I like that because it doesn't mean that we're creating another job, but that we're layering these things into our accounts to put our cash to work, right, Ed, in our options portfolio.
Yeah, thank you, Bobby.
Yeah.
And I want to welcome everyone. Good afternoon. The session's on T-bills. Today, we're going to be covering these short-term treasury obligations and how they can facilitate an extra return for your account with little effort on your part and little effect on your buying power, especially when you're trading options and especially when your option trading is tilted towards selling options. In my opinion, because of margin, today's higher interest rates and T-bills make them an important component of your total return. I'm going to go through the mechanics today of what they are, how the auction works, how the secondary market works a little bit, and how to calculate a return from these. So with that, I'll begin with a little information. This first page is, and I've basically taken everything from the web, so you can kind of make a note of what I'm using and go back to this and refer to it if needed. Okay, sorry, I'm moving one little thing here. Okay, what is a T-bill? Okay, so a T-bill is a treasury obligation. It's an issue, it's a debt obligation issued by the Department of the Treasury, which is, of course, a division of the U.S. government. T-bills are the shortest term debt instrument that the U.S. offers. They are offered at a discount. So when you buy $100 worth, you're buying it at a discount. I'm going to take a quick second and show you last week's 4-week T-bill rate. It's per $100, you paid $99.71.84. Okay, I'll get more to that in a little bit. So you buy them at a discount, they mature at face value. T-bills are issued in 4, 8, 13, 26, and 52 weeks. And the 4, 8, 13, and 26 week T-bills are sold weekly by the government, and the 52-week, which is a 1-year T-bill, is sold every 4 weeks. For our purposes, we're going to focus on the 1 and 2, the 4-week and the 8-week, and we'll touch on some other ones and when you might want to do those. Some interesting takeaways. Okay, as I mentioned, Treasury bills are debt obligations issued by the U.S. government. They have the shortest maturity of all debt issued. You can purchase T-bills in $100 increments in non-competitive and competitive bids. We'll go over that shortly. And T-bills, this is important for anyone who has a state or local tax. T-bills are only subject to federal, not state and local taxes. If you're curious as to why, it's because the feds and the states have a reciprocal agreement. The states will not tax treasury obligations, and the U.S. government will not tax state debt obligations like municipal bonds. We can get into that in the future if you guys want to go there. Yields on T-bills are generally lower than similar investments such as CDs. That is not the case in the current world today. That is because banks are generally stuffed with excess cash that they don't know what to do with. So they are not offering competitive rates. That's one reason our money market rate at our brokerage firm is basically pathetically low. And the rate we return, a rate of return we get at banks is also very, very low. What's the difference between a treasury bill and a treasury bond? Okay, so a bill by definition is 1 year or less. A treasury note is 2 years to 10 years. And a treasury bond is 10 years and longer. They currently go 10 to 30, although as this says, there's some contemplation about extending these to 50 and up to 100 years. Frankly, I think that would have been brilliant 1, 2, and 3 years ago when rates were squished down to zero. They could have gone way out and refinanced new debt at a much lower rate for a longer period. I think that window's closed. Okay. How to bid for T-bills. Okay. There's two ways to put in an offer on a T-bill. For our purposes, we are using a non-competitive bid. That means we put in our order for the T-bill, and I'm going to go through the mechanics of that shortly. And our bid goes in with millions of other bids for T-bills. And when we put ours in, as this indicates, it's kind of like a market order. It's kind of like doing a stock IPO, very similar in that you put your order in, the final price is reached, and you get the final price. A competitive bid, and there are limits. There are limits on how much maximum dollar amount you can put in a non-competitive bid. And that allows we smaller people to take advantage of the non-competitive bid and not bid competitively. A competitive bid is one where you put in a desired interest rate for your desired amount of investment. So if you have a giant institution that has $1 billion worth of cash that they want to put in, say, a 1-month T-bill, there are limits to the amount that they can do it. It's far lower than that. I'm not going to go into those details because they don't really involve us. But the competitive bid allows them to state a yield that they are willing to accept. And I'm going to bounce back to last week's 4-week T-bill again. So 28 days, so it's a 4-week. You can see that the low rate was 2.7%. That means someone went in and said, I will take 2.7% for my 1-month T-bill. They knew the rate was higher, but they have so much money to invest, they're willing to take a lesser rate just to get their piece taken. Okay, so we're going to go back to this now. Okay, the tax treatment, we went through that already. Safety. Okay, so the safety of these is the utmost safety. The U.S. Treasury debt at this particular point in time is considered the highest safety in a debt security that there can be. That's basically because the world is willing to accept our debt in virtually unlimited quantity at this point in time. That may not always be the case. But currently we are the, quote, safest and most secure, unquote, debt instrument on the planet, particularly one coming from an entity that has a large available supply. In other words, the Swiss franc may be a more stable thing to invest in, but they're not offering a lot of debt. So anyone that wants to acquire a rate of return on a fixed income investment, there are limited issuers around the world that are issuing enough debt that people actually want. For instance, if China's offering debt, there's going to be less demand for it in the world market than the United States. So I'll just give you that example. And we'll move over. We'll move on. Okay. So the next thing I want to go into is, this resource page. Now, this resource page, I'm going to cut and paste this into the link. And I've put this out there before. This is the Treasury Department's yield curve page. And again, I have it set to the daily Treasury par yield curve, and I have it set for the current month. You can also go back and look at past years, going way, way, way back. I like to look at the current month because it gives me an idea of what rates have been doing. So in this example, again, this is a yield curve. A yield curve is usually referred to treasuries in that it takes the 1-month rate and compares it to other maturities, 2-month, 3-month, 4-month, 6-month, 1 year, 2 year, 3 years, 5 years, 7, 10, 20, and 30 years. A normal yield curve slopes upward like an exponentially increasing thing. Whether it's an investment, a stock going exponential or rates. The shorter term rates are generally lower than longer term rates. And that is for a number of different reasons. The main reason is short-term securities are less risky to the holder than longer-term securities. I'm not going to go into a lot of detail here, but interest rates on a fixed income investment and bond prices are inversely related, so that when rates go up, like they have been doing lately, existing bond values go down. So any of you who have fixed income securities in your account that are longer term, you have seen them take a hit. Any of you who are unfortunately cursed with mutual fund bonds, mutual funds made up of bonds, have really gotten hurt this year, maybe more so than even your stock investments. Again, separate topic for future discussion. In general, though, a 1 month is less risky than a 30-year because you know your rate is going to get reset every month. So you're generally willing to take a lower rate for a 1 month than a 30-year. Again, if we look here on the 7th, this is yesterday's rates, the 4 week, I call it 1 month. It's not really a 1 month, it's a 13 week. A 2 month, excuse me, a 1 month is a 4 week, a 2 month is an 8 week, etc. And we're going to get into more of that granularity later when we're calculating a return. But just to go into this yield stuff, if you look on the 7th a little more, it's 3.7, then we went to 4.04 for the 8 week. The 12 week is 4.29. So you can see rates are trending higher for the 4 month, higher for the 6 month, higher for the 1 year. And then something happens between the 1 year and 2 year. See how the rate drops? That is because starting at 1 year in the current market environment, rates are starting to invert, meaning the 1 year is higher than the 2 year, the 2 year is higher than the 3 year, etc. As it goes down and out all the way to the 10 year. Then we bump out to the 20 year, you see it uninverts. The 20 year is higher than the 10 year. And there's also comparisons. There's a lot of comparison in the current market world where we're comparing the 2 year rate, which is 4.72, with the 10 year rate, which is 4.22. So you can see there's a 0.5 or half a percentage point inversion between those. When rates invert, it is generally considered a recessionary thing because longer term rates are reflecting the fact that there could be economic softness, which could lead to a lowering of inflation, etc. Okay, I'm going to stop there and I'm going to accept all questions at the end. If you don't mind, Bill, I see your question. I'm going to get into that in a minute. Otherwise, in general, if you'd hold your questions till the end, I'm going to do my best to answer everyone's question. Also, following this recorded session, we're going to go unrecorded. I'll be happy to answer questions then. And for anyone that may want to be guided additionally through the purchasing process, I'm happy to do that with Ameritrade, which is where my account is, where I do the T-bills. And that being said, let's get into some mechanics of the auction. Okay, so for this purpose, I use treasurydirect.gov, all right, which is another Treasury site. They give you, this site is pretty handy. This is also the site you go to buy your I-bonds, which have to be purchased through the Treasury Direct site. I-bonds cannot be purchased anywhere else besides through Treasury Direct. Other bonds, T-notes, T-bills, and T-bonds, Treasury bills, Treasury notes, and Treasury bonds, can all be bought through Treasury Direct, or in our case, we want to buy them through our brokerage account because they remain in the brokerage account and they are highly marginable, meaning you can borrow a lot of value against them. T-bills, the shorter term T-bills, you can borrow 99% of the value. Now, there's a little nuance between what you can borrow and what you can borrow without creating a margin loan. We're going to get into that in a little while as well. So right now, I'd like to bounce into when auctions happen, okay? So, and again, I'm at this Treasury Direct site. I'm in auctions. There's a whole handy list of things to do here to look through. I'm in the upcoming auction section. Generally, the auctions take place Okay. They take place weekly. The 4-week, 8-week, 13-week, 4-month, 6-month, and 1 year, they all come out weekly. The 1 year, the 52-week only comes out monthly. So if you look at this here, the 4-week, and these are going in order of what's being auctioned right now. Okay, I don't know why they put the 17-week before the 4-week. Usually it's first. So today, for instance, today is the 8th. The government has announced there's a brand new treasury for 4-week and 8-week securities. Here's the 8th, and they also are doing 17-week today. And that means your window has opened. Your window is open today on the 8th. It closes sometime on the 9th, very late on the 9th. And those are the times where you can go and put your order in with your broker. We'll go into that in just a second. In fact, let's go into that now. All right. Here I am in the, you have to do the purchase on your on the web. You can't do your purchase inside the Thinkorswim platform. The security does show up in your platform after the purchase is settled. So if we go back here, you can see there's an announcement date. It's usually 2 days, and then they have, it's announced today, they open it today, it's open tomorrow, and they close it on the 10th. And the auction takes place on the 10th. The rate is declared later on the 10th or on the morning of the 11th. And then the issue date is a week after the announcement date. So if you purchase a T-bill, put in a T-bill order today, it sits today and tomorrow. The auction goes off Thursday, and it settles next Tuesday. That is when the T-bill money has to be in your account for them to take it out. Like a stock trade, like with a stock trade, you have trade date +2. With this, you have trade date plus apparently 3, because it closes on Thursday the 10th, and on Tuesday, the money's taken out. A little strategy move, and I'll get into this more at the tail end. Please remind me again. Once you buy a T-bill at auction on Tuesday, it settles on Thursday. Or the auction date is on Thursday. It settles the next Tuesday. So anything ordered today will settle Thursday, closes next Thursday. They take next Tuesday, they take your money out of the account. If you have extra money in the account in the meantime, they will take it out on the 10th. If you don't, if you have maxed out your account with buying power and T-bills, it will allow your existing T-bill that is maturing next Tuesday to be purchased a week in advance, which is today, so that you can put your order in today for next week's settlement, so that if you're rolling 4-week T-bills, you basically in week 3 want to put your order in for next week's order, and one matures and the new one comes in, and you have 0 lapse in interest. I'll be happy to go over that later as well. So these are upcoming dates. For our purposes, we're interested in the 4, maybe an 8. Probably that's going to be it, but I'll get into laddering, which is how you can structure these things in a little bit. Here's some auction results from recent weeks. So again, I'm going to use this one as an example. It was last week's 4-week T-bill auction. And I can click on this. Actually, my apologies. It's a different area. Okay, so this is last week's T-bill results. So the issue date, again, the execution date, the date that it was done was the 10th. Orders went in on the 8th and 9th. It settled on the 10th, or the auction date was on the 10th. It settles on the 15th. This is the page for that result. Some of you have bought these. I believe Bobby bought one. I've had a couple of the people that pinged me. You bought the for every $100 of T-bill you purchased, you paid 99.718444 cents. Okay. These other numbers kind of show what's going on here. So the median rate, and they're defined down below. When you find this page on that Treasury site, all these things are defined. When we put in a non-competitive price, which is what we will always do, our order is thrown in with all the other non-competitives, and it's thrown in with the competitive bids. And those are ones where people have the larger amounts that don't qualify for the non-competitive. So if you have a giant institution that wants to go in, like here's the low rate from last week. Somebody actually bid 2.7%, knowing that the rate was higher just because they really wanted to get their big chunk of T-bill in there. And again, I'm going to bounce back to this resource page. Like today, when you're looking, do I want to do this T-bill or not? You can look at, this is yesterday's rate. This thing updates every day at around about 30 minutes before the stock market closes. You can just hit the refresh button. It'll populate November 8th. It'll give you the rate. So yesterday's rate for a 1 month, which again is a 4-week, is 3.78. That is about the rate that you can expect on your T-bill. Sometimes it's a little lower and sometimes it's a little higher than what you would expect because market rates have bounced around. So this might be a few basis points higher or lower. In this case, last week's rate, this 3.62, was actually a little lower than the yield curve rate, which is just a little nuance. It's going to happen every now and then. The main thing to remember here is when you buy a T-bill, you're buying it a face value of 100. You're buying it at a discount to face, and it matures in 4 weeks for the face amount of 100. So you're buying it for 99.7144 cents, blah, blah, blah. That equates to this return. I'm actually going to calculate this for you guys later on. Okay. So the next thing I want to show you is in the Ameritrade account, how do you get to the bond purchase area? How does it work? Etc. So when you log in, you'll be brought to whatever page you're brought to. Here, I'll just go to the My Account section. We'll take a look at it. Okay, well, it's going to let me do that. Okay. All right, so you go to Trade, Bonds and CDs, and then you go to Treasuries in this section. This is actually going to bring us to the, yeah, Drew, I'm sorry, I'll get into that later. I'm sorry for the pause, guys. I want to make sure there's nothing real timely going on here. So I'm going to get into some of the technicalities of all this later. What I'm about to bring you to is actually the secondary market. So the auction takes place on, you put your order in on Tuesday and Wednesday, closes Wednesday, auction goes off Thursday, it settles the following Tuesday. There's no commission to buy. When the thing matures, there's no commission to sell. It just flows right back into your account, just like they took the money out to buy it in the beginning. So I'm about to show you the secondary market. The secondary market exists because people who buy in the primary market at the auction, sometimes they don't want to or can't hold it until maturity. If someone buys a 6-month T-bill and there's a month and a half left and they sell it, it will go back into the secondary market for others to sift through. So this is the secondary market. I'm going to go into the new issue section, which covers auctions, but I do want you to be aware that there's a secondary market. So if you need to sell one of these, and we're going to get into those technicalities later, there is a very, very active and tight market for these things. I also want to point out to you as a nuance of this, the secondary market offers you an inferior rate to the auction. And that is because when you buy the treasury, you're paying 99.718. If you turn around and want to sell this tomorrow, Ameritrade's going to buy it back and they're going to resell it in the secondary market. So they have to buy it back for a little less than it's worth and sell it for what it's worth. So that is why rates are kind of crummier there. So I want to focus on the auction. Okay, so I hope you guys saw where that was. Let me go back in case someone missed it. Oof, something is wrong with this internet connection. All right, I'm gonna go back here just to walk you through it again. Go back to treasuries, click here. That brings you to the secondary market. You look on the side, it says new issues. You click on new issues. And there are other ways to skin this. You can go into trades and research and go to the bonds and research wizard, or just the bonds and CDs. It's going to bring you basically to these same pages. So here we're going to go to new issues, and then we're going to click on treasuries. So we can do it here, or we can do it here. I'm going to do it here, and we're going to go to treasury auctions 0 to 1 year, because those are T-bills. Those are the primary focus that we have. This brings us to this page. This is the new issues treasury auctions page. So if you scroll down, these little circles indicate live auctions. So this 4-week T-bill and the 8-week T-bill are actually live auctions. If you notice, there's also a 10-year and a 30-year auction going off today, which is not of our concern. But you can see that all these treasuries from 4-week all the way out to 30 years, including TIPS, which are Treasury inflation protected securities. We'll go over that another time, not today. They all have their little period where the auction window opens and closes. So again, the 4 and 8 week open on Tuesdays and are open Wednesdays, close late Wednesday, and the auction goes off Thursday. The 13 and 16 week are open Thursday and Friday, and those settle Thursday. So Thursday and Friday, the 13 and 26 week are going to open. We'll get into when you might want to invest in those, but for initial purposes and for simplicity's sake, I'm going to focus on the 4-week, and we may get a little fancy and get into the 8-week, but generally you want to buy a 4-week and just roll it from one to the next, as I described earlier. So I'm going to go in and do a pretend order now. A pretend order, I say, because this is my old IRA account at Ameritrade. I only have 20 bucks in it, so I don't really have enough money to do the order. But you get to this section, you want to do a 4-week. Remember, they announced the auction starts today, which means it's open today and tomorrow, closes late tomorrow, and on the day after Thursday, which is Thursday, the 10th, they do the auction. So you click the little button, you want to do it, then you scroll down to the bottom. How much do you want to buy? So these are in thousands. So the number 1 indicates that you want to buy $1,000 of a 4-week T-bill. If you want to buy 50,000, you put in 50. If you want to buy 100,000, you put in 100. And then you click review. Okay. And this takes you to what you are about to buy. It says you want to buy 100. It's a 4-week T-bill. This is the CUSIP. The CUSIP is the identification number for this particular Treasury bill. Everything has a CUSIP. Treasury bills, Treasury notes, bonds, stocks, warrants, preferred stock, everything has a CUSIP. The CUSIP is the way that the behind the scenes brokers and dealers process these things. So anyway, this goes into the details of what we're looking at here. We're looking at the 4-week T-bill. We're tentatively looking to buy 100 of those, which is 100,000. The auction date is today. The auction closes on Thursday. So if you wake up very early on Thursday morning, sometimes you can still squeeze an order in. I find they close late on Wednesday, and sometimes early on Thursday, you can still squeeze one in. It shows the settlement date, which is 1 week after the auction date. Start, again, the auction is actually on the 10th. That's the settlement date. The price is auction because it's to be determined. We're putting our order in a non-competitive fashion. So all the orders are going to go in somewhere around the average rate that they need to fill everything is that's a little simplified, but that's essentially it. That's the rate, and it'll get declared at auction. When the auction ends, they'll declare it, and then we'll go look at this. And there'll be a page just like this one for this auction that's coming up. It'll tell you all the guts that are needed that went on in that auction. And then you just click, change order. I'm going to click do not place. See, it says I can't complete it because I don't have enough money in the account. If I did, it would let me do it. I'm going to click do not place. It's going to send me back here. Okay. So that really is the mechanics of how all of that works. Now, I want to take you, because I've been bouncing to this page and you're like, okay, I buy it $100 worth for 99.71 or 72 cents. It sounds like pennies. Tiny, tiny little pennies. It is tiny pennies. Let's go into some math on how these things are calculated. And I will bring that up in just a second. Okay, so here are last week's results. I've been referring back to that page. It was a 4-week T-bill, and we're going to calculate the rate of return on that one. Okay, so as I've been mentioning, the face is 100. That's what it matures for. The purchase price determined at the auction was 99 point. I'm going to call it 72 cents. I actually rounded up. It was 99.71444. I left off that part. We're just going to round it off to 99.72. But for this purpose, every time we chop off part of a penny, we're impacting our return for calculation purposes. So the difference between the face value and the purchase price is the discounted amount. That is what you pay. The difference between the two is what you earn, which is 28.16 cents per $100 purchased, which again, we're talking pennies, but hang in there. So for every 100 of face you buy, you're going to earn 28.16 cents every 4 weeks. There are 13 4-week periods in 52 weeks. 52 divided by 4 weeks is 13. So if you buy a T-bill at auction on a Tuesday, it settles on Thursday, it closes on Thursday, your rate's determined on Thursday, it settles the following Tuesday. That's when you start earning interest, and you earn it for a whole month. If in week 3, you're like, I want to roll this thing over and keep doing, you can do that 13 times a year. So basically you can take this 28.16 cents per 100 and multiply it times 13 weeks. So for every year, and the rate's going to change every 4 weeks, as you guys have probably figured out by now, the rate's going to be a little bit different. I'm just annualizing last week's rate out for a 52-week period. So that 28.16 cents times 13 is $3.66 per year per $100 of face. So if you take 366 and divide it by 100, you come out with a 3.661 rate of return. So for every 1,000 in 1 month T-bills purchased and rolled every month, the T-bill holder will receive $36.61 per year. Again, it sounds like squat. Why am I bothering with this? Why is Ed having such a fit? Why is Ed pushing this? All right, so for every 1,000, that's what it amounts to, but this scales up. So for every 100,000, we're using each T-bill is 1,000. I think the brokerages require you to buy 1,000. You'll check with your individual brokerage, and we'll get into commissions, et cetera, for others, because some brokerage firms do not allow participation in auctions. We'll get into that in a little bit as well. So for every 1,000 in T-bill, you're earning that $36.61. There are 100 of those per 100,000, which basically computes out to $3,661 a year in interest. So for every 100,000 you have in your account that's not being utilized for buying power purposes, you can earn $3,661 per year. Now, that rate is likely to go up because you guys know that the posturing of the Fed right now is to continue raising rates. So as they raise rates, these rates will continue to go up. And as long as you're rolling, you will continue to have whatever rate they're offering, and that rate will be going up over time, in my opinion, in the near term. Okay, hang on a sec. I'm not so slick like some people are on these things. Okay. Okay, now I'm going to pause this and go into a little bit of a question and answer period. And then I'm going to do some more analysis like laddering and choices of laddering. Okay, so question here. First one, do you use your broker to buy T-bills or do you buy them from Treasury Direct? I'm recommending that everyone buy them through your broker, because when you buy them through your broker, this is the secret sauce of all this, okay? When you buy it through your broker, a 1-month Treasury bill, say you buy $100,000 worth, they're going to hold back $1,000, and $99,000 can be used for margin purposes, for buying power purposes. So this gets a little squishy on understanding. So I'm going to ask everyone to have a leap of faith and go through a little learning period. So as I did at the beginning, because even being familiar with all this, I have a portfolio margin account. I wasn't sure how portfolio margin was going to handle these things. I will tell you, don't be scared off if you don't have a portfolio margin account, because I also have an IRA account where these same principles apply. You still get a lot of buying power relief, and you still get to use the bulk of your money without incurring a margin loan. So there's a difference between a margin loan where you're borrowing money from your broker and having a margin balance. And we're going to get into that in a little bit too. But to utilize the buying power of your cash when investing in T-bills, it has to be done inside your brokerage account. So buy them in your brokerage account, and that's that. If you have tons of money and you don't need your cash for buying power purposes, you could still do it in your brokerage account because it's easy to do and it's free at auction. If you don't have it, like IBKR, from interactions with others over the weekend and recently, from what I'm being told, Interactive Broker does not participate at auction. The only way to buy these is in the secondary market. That makes it a little more challenging because the rate is not quite as good. But this person was indicating that IBKR looked like they were charging a flat $5 fee. So obviously, if you're buying a $1,000 T-bill, you're not going to really earn enough money to cover that $5 commission. But if you're buying $100,000 worth and you're earning roughly $70 in that 4-week period, you can afford the $5 that it's going to cost you. Okay, that's just one example. I hope that's clear. Basically, in a nutshell, you want to buy these in your brokerage account so you can get the margin relief and therefore buying power of the T-bill in your account. All right. The next question, who should be using and not using these? And how much should someone have in their bank account before looking at purchasing these? So in my opinion, the money in your brokerage account is the money that you have available for buying these. If you have a lot of other money in your regular banking account, say your household account where your income comes in and your expenses flow out, if you have a lot of extra money in that account, you should put that money in your brokerage account and buy a T-bill with it. That's perfectly acceptable. Don't stretch your personal home account buying T-bills because there's not really enough benefit to doing that. So basically, this is kind of a medium to larger account pool. And by medium, that's going to be subjective. What is a medium account? What's a large account? It's very subjective. I'll tell you this. If you have X amount of money in your account, let's say you have a $50,000 account, and your buying power doesn't typically go above 30%, and you really never intend on letting it go above 40%, but it usually tracks in the 25 to 30%. At 30% of 50,000, you're using $15,000 in buying power. The other 35,000 is sitting there in your brokerage account, earning whatever your broker is generously paying you. Up until recently, this amount was 0.01. 0.01% is what Ameritrade was paying. I can't speak to other places. I don't know. I know Interactive Broker pays more. They're pretty much one of the best for cash balances. Since then, in the last month or two, I've seen where Ameritrade has raised their rate from 0.01 to 0.3. I have also spoken with the portfolio margin a few times, trying to figure a lot of this stuff out. And they've indicated that they're seeing a massive rush to T-bills. They don't understand why. So I basically explained to them because they're ripping we customers off. So that's what's going on there. Let me look for another question. So basically, any cash you have, let me reiterate that a little bit. Any buying power, available buying power that you have is available to put into a T-bill. I don't recommend. So for instance, let's use this example. Let's go to a $100,000 account and you're typically at 25 to 30%. So you're usually using about 30,000 of buying power. You have $70,000 sitting there that's not being used. It's being paid the broker rate, which at Ameritrade is 0.3, and you're basically giving up the 3.7% rate that you could get on a 1-month T-bill. My purpose in the T-bill is to create what I'm calling my own, I call it EDS 100% government-backed money market fund. So what I've done is I've taken my excess cash and put into these T-bills, and I have them laddered from 1 to 3 or so months. And so one's coming due monthly, if not more often. And instead of earning 0.3, I'm earning 3.7. So for every 100,000 I put in, instead of earning $300 a year, I'm earning $3,700 a year. So I hope those numbers are playing out in your head and it's giving you an idea of how beneficial this can be. And that's per 100,000. If you have a much bigger account, and I have spoken to people here in the Trader Nerd community, there are quite a few people with millions of dollars in their account. Most of that is invested. Sometimes it's not invested. People are either heavy cash because of the market. They've been scaling out as the market fell, stop losses, etc. Whatever the reason, these are tremendous. This is a great income enhancer. So again, for every 100,000 of excess cash you have in your account, which might sound like a high-class problem, it is a high-class problem. But if you're letting it sit there, it becomes a real problem because you're giving up, you're earning $300 a year from Ameritrade instead of $3,700 a year by doing the T-bill roll. So you're giving up $3,400 every year. That's almost $300 a month you're giving up by not utilizing this strategy. So again, in that regard, if you're cranking out your account, you know, we're all slinging these options and doing our own thing. Some people have longer term positions, et cetera. Whatever you're trying to make your rate of return, if you're targeting a certain rate of return, instead of targeting that return, you can add in the extra return that you're going to earn by utilizing your unallocated cash, the cash that's sitting there. And for those of you who are at Ameritrade, look in your Thinkorswim platform, and under the account info tab, it has cash and sweep vehicle. That's the amount of money that you have sitting there that's not being utilized for margin purposes. That's the amount of money you can initially take an overall look at on how much I might want to use. And if you have $100,000 account and you have cash and sweep of 80,000 because you've only used 20% buying power, then you have up to 80,000 that you can put into T-bills. I do not recommend you put 80,000. I recommend you leave 20,000 there and look at maybe doing 60,000 in that example. And for the people that are starting, like this might be their first T-bill ever, if you've determined by that formula, I have 100, I'm using 20, I have 80 unused, how much do I want to put in? Set aside an extra 20 for now and only look at 60,000. Of that 60,000, I would personally buy 30,000 the first time. Let the 30,000 settle in your account, get a feel for what's going on. You've still left the remaining 30,000 and the other 20,000, which was a cushion that's not being utilized for buying power purposes. Let that 30,000 go into your account. Let you look at how it looks in your account. Look at your metrics, look at what it's taking up, look at your cash and sweep vehicle money. And then next week, you might want to take the other 30,000 and buy another T-bill with it. You'll still have, if your buying power is at 20%, you'll still have another 20,000 of cushion buying power, if you will, and you'll have $60,000 working for you, earning not 0.3%, but that 3.7%. So that's roughly, I don't know, something like $2,200 a year. It's real money. It amounts to real money. So, and I'm recommending the edge in instead of just plopping the whole 60,000. You could do the whole 60 because you still have 20,000 of leftover money for buying power purposes. All right, these are little technicalities. I'll be glad to drill in on some of this more. Let me look through this next question. Okay, what happens when buying power spikes? So let's say you're at 20,000. You have 100,000. You're at 20,000 of buying power, so you're using 20%. The market tanks. Your buying power percentage rips higher, and you go to 40%, or you go to 50%. Okay. Your cash and sweep, if you've allocated first, if you're using 20% buying power and that's 20,000 and you leave a $20,000 cushion, then your buying power can double from 20% to 40%. And all you're going to use is that excess cushion. You're not going to be in a margin situation. If it goes higher than that, that cash and sweep vehicle number is going to be a negative number. And that tells you how much margin loan you are incurring. Okay, you do not want to incur a margin loan because you are earning 3.7% on your T-bill. That's what you're earning on this money that you're trying to max your return on. Ameritrade's on the opposite end of that. If you incur a margin loan, I don't know what their current margin loan rate is. It was 10% a month ago. I'm sure it's probably 11% or more now. So when you incur a margin loan, they're going to charge you 11%. You do not want to buy so much T-bill that you're incurring a margin loan because you're going to be earning 3.7 and paying 11. Clearly, we don't want to do that. That's another reason I'm going into the details of how to monitor this. And once you start stepping into it, you'll get a great feel for it, just like you get a great feel for your buying power. The first time you do an option trade, you may not understand buying power. You may not understand what it does to your account. But as you do one trade, you can see. As you do another trade, you can see. And you can also see how many trades you can do based on your cash to hit your max buying power. This fits in right with that. If you scale into it, in that example I just gave, where you take your 60,000 of excess, leaving a $20,000 cushion, you can either roll the 60 into a T-bill or you can edge into T-bills by doing a piece of that and seeing what it does to your account so you can get a feel for what it's doing to your buying power, just like adding your positions do. So that if you do see a negative number in your cash and sweep, You simply log into your brokerage account via the website. You go to your security, you click on your security, you tell it that you want to sell, and you tell it how much you want to sell. About 6 weeks ago, I had stuffed my account with so many T-bills, and I'm going to go into some details of that in a minute, just because you guys are probably curious. It's kind of amazing. So, sorry, I lost my train of thought there. All right, so let me go on to more questions. I'm sorry, I kind of lost that there. Bring me back if someone wants to. Can I explain a margin loan on an IRA? There is no margin loan on an IRA. You can't, an IRA is not a marginable account, but I have an IRA account and it is set. Oh, thank you, Candy. So I was so stuffed with T-bills that I had a negative number in my cash and sweep. So I'm now bouncing back to my example that I was rerouted to. So I had to correct that. I went into my account, I pulled up one of my numerous T-bills, clicked on the nearest term one because it was the one coming up in like 8 or 9 days at the time. It's the one closest to face value, or $100 per 100, because it's the closest to the maturity of the T-bill, where you get the full face back. And I just told it, I had a $12,000 deficit. So I sold $15,000. So I clicked on the one I wanted to sell. I clicked sell. I typed in 15 because I needed to sell 15,000. I clicked send. It says, here's an approximate bid. Do you want to accept? I clicked yes. I refreshed the button a couple of times. It was sold. My negative balance in my cash and sweep vehicle in Thinkorswim immediately went positive, and life was good from then on. So it's not a catastrophe if your number goes negative on the cash and sweep. You have, I think, 2 business days to settle it. But regardless, if you go in and adjust your T-bill holding and liquidate enough to cover that negative amount, it washes out immediately. Yeah, someone just said, doesn't Ameritrade include the commission in the secondary market price that you see on their website? Yes, they do. In the case where I sold 15,000, I called them and I said, what's the commission? They're very vague on what their commissions are. They generally do not, in the secondary market, charge more than $1 per 1,000. So if you buy $20,000 worth, the most they're going to charge you is $20. But they also said it's in a formula, so it's weird. When I sold $15,000 worth, they charged me $2.10. So they didn't charge me $15 or $1 per 1,000. They charged me 21 cents. No, and they charged me less than that because it was 15. What was that, 17 cents or so? It was almost nothing. It's incidental. The commission on these things, when you're doing it in the volume that you need to, is really insignificant. Okay, let's see. All right, what other questions do you guys have? Oh, let me give you this example. I was saying I was stuffed with T-bills. At one time, I had 90% of my multi-$100,000 account in T-bills. Right now, I'm at about 83%. So for every 100,000 I have in my account, I have about 83,000 in T-bills. In addition to that, right now I'm looking at my cash and sweep, and it's a little more than 15% of my account. So I still have 15% buying power left to utilize in my whole account before my cash and sweep goes negative, before I have to worry about liquidating a T-bill. So in my personal account, I'm finding that I can leave way over 80%. And I'm under allocated on positions right now. For those that may be following my little mantra and thought process, I'm under allocated. I'm about to be out of whack, out of contact with my account much of next week. And I just don't want a lot of risk and activity going on there. So I have fewer positions than normal, but I've left enough in the account to bring it back to my full book. So even at what I consider a full book, I'm going to have 83% of my money still in T-bills. So there's great opportunity there. So what happens if at maturity, you do nothing. So when these things mature, if you have not placed another order for your T-bill a week ahead of time, it just matures and goes right back into your account. So the day it matures on Tuesday, your cash, your net lick's going to go, well, it's not going to be changed because this is included in your net lick. Your option buying power will go up. Your cash and sweep vehicle will go way up by the amount of the T-bill. So it just flies right back into your account, just like they yanked it out. And it's going to go back into your account and immediately starts earning whatever their declared rate. In the case of Ameritrade, it's 0.3%. Can you sell a T-bill on the TOS platform? No, you have to go to their website. And in fact, I logged in today on a regular web page. Sometimes it makes me go to an incognito window. I don't know why, but their bond page is almost Java driven. Like I can't go to it on an iPad. So I couldn't get to it on an iPad. I suspect you can't get to it on an iPad. It's not an iPad friendly site. So yeah, the money flows right back into your account with no effort on your part at all. In that situation, really you want to make a note. And again, it's going to show up in your Thinkorswim account. If you buy 10 of them, it's going to show 10. Just like when you do an option, it shows 1 or it shows 2. You click on that 1, it shows you the date that you purchased it, the price, and the current value. All that is also shown for the T-bill. Okay, the last thing I want to go into, and then I'll open it up for more questions, is laddering. Laddering is spacing out of your T-bills. The simplest way to do a T-bill, and it's what I'm recommending for everyone who's new, is just to go out and buy the shortest maturity, this 1 month, and they say 1 month, it's actually a 4-week treasury, okay? So this one, go out, click this. You're going to be buying the one that it starts today, it ends tomorrow, they do the option Thursday, and it settles next Tuesday. Do that one, and do it for about half of the cash that you think you want to do it for. Like I said, let it go in there, get a feel for what it's doing to your account. You're not going to hurt yourself doing this. The worst thing you do is accidentally overbuy a T-bill and create a negative cash and sweep vehicle situation, and then you go in and click and get out. It's really not that big a deal. I am also stating I am here for the community. Anyone that wants to private message me, please private message me. If you have a general question and you want everyone to know, go into the fixed income section of our community under treasuries and ask it there. I will see it fairly quickly. If it's something urgent, PM me directly and that'll pop up, and I'll get to that again relatively quickly. I'm usually sitting right here watching. So that being said, laddering for the beginner, just do a 4-week. And then 3 weeks from now, if you want to renew it, click the button, it automatically renews, so you don't have any lapse in interest. If you want to get a little more sophisticated, if you have a good bit more amount of money to invest, no matter what, you can always keep it at the 4-week and keep rolling, 4-week, 4-week, 4-week. And every 3 weeks, you click it and you buy it for that 4th week maturity, and it matures and it settles the new one that you purchased the prior week, and you're just rolling it for one or the other, roll, 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 no loss of interest. Because I have a larger amount that I'm doing in T-bills, I do a 4-week, an 8-week, and sometimes a 13-week. Earlier in the year when I first started doing this, the 13-week was paying almost a full percentage point more than the 4-week. So I stretched out some money and went further out in time. Right now, I'm pretty much running the 4 and the 8-week. And that's how I do it. So I'll do a 4-week. Like for instance, last week I did a 4 and an 8-week. So in 3 weeks from now, the 4-week will be maturing, and the 8-week will still have 4 weeks left on it. So I can, when that 4-week one matures, I can either roll it into another 4-week, or maybe I want to roll that one into a 13-week because my previous 8-week T-bill is now a 4-week T-bill, if you will. If this is all getting to be like your eyes are rolling in the back of your head, again, we may have to do another session. I'm available for further questions and commentary. I do want to shut it down now. We are right at the hour mark, and I don't want to go too long. I've covered the bulk of what I need to do. Okay, Joe is asking for how to sell. Let me show you. All right, let's stop sharing for just a second. Anyone else have questions while I'm looking this up? Okay. So let me show you guys how to sell. So this is my main account where I have all the T-bills stuffed in it, okay? And this is one of them. This is a $50,000 T-bill, okay? So let's say I wanted to sell 10 of it. Oh, good job. Okay, someone just placed their first order. And again, you have the rest of today and tomorrow to get this order in. I'm very willing to help. And we'll get into that. Let me get into this. So this is just the T-bill I selected. It's 50,000 face. It doesn't show it here, but I kind of hid it from you before I got here so you wouldn't see all my other stuff. This particular one matures December 13th. So basically, if I want to sell, let's say I want to sell 10,000 of it. Okay, there's 10. It's going to calculate the cost. This is the estimate of what I think I'm going to get, 3.229. Okay, this is all in thousands. Okay, so like this 10,000 is actually 10,000, so that's 10 million. The point of all this is I have to select a maturity, select a tranche. These are different tranches of T-bills, if you will, that will accommodate my 50 purchase. And this is a little technical. I don't want to drill down on it too much, but you can look at the yield to worst, yield to W's worst. The 3.229 is the one it's highlighting. So you basically pick one of these and it allows you to sell at roughly that rate, the 3.229. And this is roughly the price I'm going to get, 99.69. Okay. And then you just click sell. I'm not going to do it, but you click sell. And then boom, the order goes in. So that's pretty easy to do. Again, I know a lot of this is foreign. A lot of this is out of your comfort zone. A lot of this is like when you first started learning about options and you heard all these terms and you didn't know anything. Good. Someone else just placed an order. I'm glad this is helpful to you all. Be patient with yourself. Remember, I am here as a resource. Again, in that treasury section, in my room, private message me. Chris, I don't think you can do an auto roll. That is something I need to ask the bond department, and they are very hard to get through to. But some places do allow an auto roll. I know Treasury Direct allows an auto roll, which means it automatically rolls into a new T-bill, so you don't have to go in a week ahead of time and click the buttons. I don't know if Ameritrade does that or not. I'll find out. Any other questions? Okay, if not, I'm going to stop the record button. Thank you all for participating, and we'll have a short additional question and answer period. Thanks everyone for coming in.